So exercise 1229A is a 15-point problem, and it's calculating net present value of an investment. There are two different ones that you're going to do on the test, but we're just going to do the first one together because the second one will be the same calculations. You'll be calculating the same way. So Walker Industries is deciding whether to automate one phase of its production process. The manufacturing equipment has a 6-year life and will cost $905,000. So this will be relevant. And the 6-year life is probably also going to be relevant somewhere. Projected net cash inflows are as follows. So we have year 1 through year 6 net cash inflows, and I'm just going to write those out to start. So these are cash inflows. So they're going to be a positive amount. If it was a cash outflow, it would be a negative amount. So 262 in year 1, 255 in year 2, 224 year 3, 210 in year 4, 204 in year 5, and then the last year, 173,000. Compute this project's net present value using Walker Industries' 14% hurdle rate. Should the company invest in the equipment? Why or why not? So first things first, after you've put in those net cash inflows, we need to find the present value factor. So it's going to be the present value of $1. 14% discount rate is what we're using. And each of these years, because it's happening in different years, is going to be a different present value factor. So we're going to go down below to the present value of $1 table, because that's a future one-time payment or receipt of cash. 0.877. So 0.877 for that first year. 0.769 for year 2. For year 3, it's 0.675. Year 4, 0.592. And then year 6, 0.519. I'm sorry, year 5, 0.519. And then year 6 is 0.456. We're going to take the net cash inflow, so the inflow cash times our present value factors to calculate the present value of each of these inflows. Romeo, you can sit on the floor. So for year 1, 262 times 0.877, that 262,000 we'll receive at the end of year one is worth what today?
229,774.
Yep, 229,774. The 255,000 that we'll receive in year two is worth what today?
$190,095.
$196,000.
Oh, 196,000. Yes, correct.
Yeah, 196,095. For the year three cash inflow of 224, it's worth, sorry, 151,200 today. You're not going on the bed. The year four, 210,000 that we'll receive at the end of year four is worth 124,320. For year five, the 204 that we receive in year five, what is it worth today?
The 204 is 105,876.
Yep, 105,876. The 173 that we receive at the end of year six is worth 78,888. The problem is asking that you calculate the present value of the net cash inflows. So you need to first add these up before we even include the outflow. So you're going to add up. I'll put C here. All six of these amounts. So the sum of C, the present value of the net cash inflows, or the sum of those six amounts equals what amount?
Is it 886,153?
Correct. 886,153 is the present value of the net cash inflows. Now we're going to compare that to the only outflow that this investment has, which is the initial investment. Okay, the initial investment happens in what year? Sorry, I'll write it differently. The initial investment happens in year
1.
0. It happens in the present.
Okay.
It's an outflow of cash. It was given to us at the top, $905,000. When we have an outflow of cash that happens immediately, the present value factor is 1.000, right? Because it's already in the present. 905,000 is our outflow of cash. We're comparing our outflow of cash to our inflow. We're adding these two amounts together to calculate the net present value. Okay, so the net present value of this investment, is it going to be positive or negative?
Negative.
Negative, because the outflows are greater than the inflows. And what's the amount?
18,847.
18,847. For this first investment, what would you suggest that management does? Net present value is negative, so we're going to recommend that they reject. The investment, because this investment's earning less than 14% return. The net present value is negative. So it means that. For the second part, you're doing the exact same thing and calculating the net present value for a second investment with some additional costs. We're not going to do that just because it's doing the same thing, and I know you can practice that on your own. Do you have any questions on this first problem?
No.
You obviously would be given the present value tables, both of them, so you'll have no problem calculating it. So we're going to move on to the next problem. And if you came in late, I had to start on time because we are going to go through all the problems that are on the test. So I want to make sure that I have enough time.
Yeah, I got the stuff for it.
What was that?
Yeah, I got everything.
Okay. For this second problem from chapter 8, chapter 12. This is a payback period problem, and it is worth 10 points. So we're going to work through exercise 1218A. The Cleveland Food Bank is a nonprofit organization that receives donations of food and distributes this food to appropriate charitable organizations. Many times, large quantities of food need to be shrink wrapped to secure the items for shipping to the charitable organizations. The VP of operations at Cleveland recently performed a time study of the time that his warehouse personnel spend waiting for the shrink wrap machine to become available. He used this wait time data and the following assumptions to determine the financial benefit of buying a second shrink wrap machine. Cost of the new shrink wrap machine plus installation is $24,000, so that's going to be relevant. Average wait time per the warehouse picker, 60 minutes. Number of warehouse pickers is 7. Hourly wages, the warehouse picker is 12. Food bank is open 5 days a week, 52 weeks a year, except for 10 holidays. Expected useful life of the machine is 15 years, and the expected salvage value is $2,000. What is the expected net cash inflow per year from purchasing a second shrink wrap machine? I.e., how much cost would be saved each year by eliminating the wait time? So we're going to go back up above. Here we have the wait time per warehouse picker, 60 minutes. And we have the number of warehouse pickers, 7. So in total, how much wait time is there?
$420 minutes.
420 minutes, right? And then we're going to divide that by 60 minutes to figure out the number of hours per day that is. So 420 minutes divided by 60 minutes per hour gives us 7 hours per day. We're going to take that 7 hours per day times our hourly wage for our warehouse personnel. And that's going to give us $84 per day. Now, that's per day. We have to figure out for the whole year. Food bank is open 5 days a week, right? So we're going to multiply that times 5. Or actually, we can do something else to shrink, to calculate a little bit easier. $52 weeks per year, except for 10 holidays. So 5 days, we're going to do it over separate here. 5 days per week times 52 weeks per year. Gives us how many total days?
260.
260 days for each year. And then we're going to subtract out those 10 holiday days. And those employees are working 250 days per year. And we're going to multiply the $84 per day times 250 days per year to get that cost. So the cost for the wait time is the $84 per day times 250 days per year. And how much is it?
21,000.
21,000. Correct. We needed that just so we can compute number 2, which is the payback period of the second shrink wrap machine, right? Because this is the benefit, the expected net annual cash inflows, the savings that we're going to see. So we're going to take our initial investment, which is 24,000, which was given, divided by our calculation from number 1 above, which is 21,000 a year. And this investment is going to pay back within what period of time?
Uh, 1.14 years.
Yeah, 1.14 years. Okay. Requirement 3. What would be the expected net cash inflow per year if the hourly wage rate used for this analysis was increased by 25% to reflect the cost of employees' benefits? So now we're going to take that $12 per year, the wage rate, I'm sorry, $12 per hour, not per year, times the increase to get the new hourly rate. So $12 per hour times a 25% increase would give us what new rate? Sorry, 25%. And I'm going to use 1.25 so that we don't have to do 2 calculations. So 100% of the current rate, which is
15.
$12, and then the $3 increase. So the new hourly rate would be $15 per hour. Amount spent on wait time per year again. Oh, sorry, per day and then per year. So times 7 hours per day. Gives us the amount, total amount per day. $15 per hour times 7 hours per day. $105 per day. Times the number of days per year worked, which is going to be 250 days, which we calculated above in 1 per year. So the cost of wait time annually is $26,250.
How did you get the 125 the 125%?
100% of 12 is $12,
Oh, okay.
right? And the 25% is the increase.
Okay.
For part 4, you needed to calculate this to calculate the payback period, the new payback period, using the increased wage rate. So now we're doing the same calculation where we're taking the initial investment of $24,000. We're going to divide it by a cost of the wait time annually, which is the $26,250, which includes the benefits. And the wait time, sorry, the payback period now becomes what? Less than a year.
And about 0.91 4 years.
Yep. So 0.91 is sufficient. 0.91 years. For number 5, it says, did the payback period using the increased hourly wage rate increase or decrease as compared to the original payback period using the hourly rate without any benefits included? So did it increase or decrease? Payback period decreased from 1.14 years to 0.91 years when you included the benefits, because those are additional cost savings that you had. Those benefits have a cost associated with them. When you have employees, you pay benefits typically. And now you're saying you have even additional savings per year. So your annual net cash inflows decrease or increase, which is going to cause your payback period to decrease. It'll take less time to pay off that initial investment because it's a higher cost savings. $10-point problem. There's some calculations. You will want to practice it. but I don't think calculating the actual payback period is all that difficult.
No, but you were saying that the reason why it went down is because we had additional cost savings associated with the increase.
Yeah.
Okay.
So your net annual cash inflows is higher. That's why. For the last chapter 12 problem, it's only a 5-point problem. Short exercise 12-5. Identifying capital investments. So you're determining whether or not it's a capital investment or not. So yes or no. So for this problem, which of the following purchases would be considered capital investments? The upgrade of the customer service fleet to new fuel efficient vehicles has a cost of $400,000.
Yeah, that's an investment, right?
Yep. Yes. It's a long-term investment. They're thinking about purchasing new vehicles. So yes. Part B, the cost of raw materials for the year is estimated to be $570,000.
Yes. No.
No.
Oh, you said long.
No, that's just normal operating cost, right?
Oh, okay.
That's purchase of inventory right there. So no. All of the computers at the help desk are being upgraded at a cost of $202,000.
Yes.
Absolutely. You're buying new assets. Long-term assets. The total cost of the management succession program for the coming year is projected to be $330,000. Are we purchasing any long-term assets there? No, we're just training our employees, so it's not. Part E, the cost to retrofit one of the company's closed retail outlets into a customer service center is projected to be $250,000.
Yes.
Yes. Yep. It's a long-term asset that's being modified. Part E, the cost to retrofit one of the company's, Part F, the cost of workers' compensation insurance for the coming year is projected to be $430,000. Nope, that's a normal operating expense. So notice these things can be expensive or not quite as expensive, but it depends on what it is. What are we purchasing or what are we spending the money on? G, to support the launch of the new product line, staff training costs are $175,000. Staff training costs.
No. So no.
No. Normal operations. H, the cost to purchase a new retail commerce system for the company's website is $1.785 million.
Yes.
Absolutely. I, the replacement of the engine on one of the company's aircrafts is $240,000. This will not increase the useful life of the plane. This is the key portion right there. Because it does not increase,
because it's not long term, right?
yeah, it doesn't increase the useful life of the plane, so you can't capitalize that cost. That goes back to financial accounting. It's expensed as incurred, it's repairs and maintenance. It's like getting your oil changed, but very expensive. J, the delivered installed cost of a new production line is $720,000. New production line, that's new machines. That's a yes. That's an investment. These are tricky. Look through them. Ask questions if you have any. But just if it's going to be a long-term asset or a new long-term asset, then you know it's going to be a capitalized cost. That's it for chapter 12.
Okay.
So chapter 13 is next up on my what I have. Let's go through at least one before we take a break, if that's okay. Prepare the operating cash flows section using the indirect method. So it's a 15-point question. You're not preparing the whole cash flow statement. It's just the operating cash flow. They give you the comparative balance sheet. So the current year is 2017. The prior year is 2016. And then they gave us some supplemental information below that we're going to use. So remember the 3-step process that we have. So we'll get back to the balance sheet, but what parts of the balance sheet we'll be focusing on, obviously, because it's the operating cash flow, are the current assets section. Don't care about the totals. And then the current liability section. Again, don't care about the totals. The following information is taken from the records of Coastal Travel Services, Inc. Land was sold for $9,200. Equipment was purchased for cash. There were no disposals of equipment during the year. The common stock was issued for cash. Net income for 2017, the current year, is $32,000. Cash dividends paid during the year were $8,000. Coastal Travel Services uses the indirect method for preparing the statement of cash flows. Prepare the operating section of the statement of cash flows. A lot of that supplemental information that was given will not be used. First things first, write out the statement of cash flow. So cash flow from operating activities. And the very first line item that we're going to include is net income, which comes from the income statement. So this is from part E. Net income for the year was $32,000. I'm going to go in the order that it's given here, so not in the exact 3-step way. We'll include everything from the 3 steps, though. The very first thing that they want you to include is the gain or loss on sale. And they sold land during the period, so that's what we're going to start with. So you will need to include a T account just to calculate this. We're going to go up to the balance sheet and find the information for land. The beginning balance for land, which was from 2016, was $121,000. The ending balance for land from 2017 was $108,000. And if we look down below, there is no mention of land except for the fact that there was land that was sold during the period. So they sold $9,200 worth of land. Sorry. Wait 1 second. Land was sold for $9,200. It doesn't say the cost basis. $9,200. They don't mention that you purchased any land, so we're assuming that the entire difference between the land beginning balance and the ending balance is the cost basis of the land sold. So what's 121 minus 108?
13,000. Or I don't know. I tried to do it in my head.
I believe it's 13,000, but I'll
It
just,
is 13,000.
I don't trust my head calculation either right now. We're comparing that selling price of the land to the cost basis of the land. $13,000 to determine if we have a gain or a loss on sale. So we sold the land for less than our cost basis, which is essentially our book value because you don't depreciate land. What's the difference? $3,800,
300.
right? And this would be a loss on sale because our books have it reflected at 13,000. We only received 9,200. In cash, we received less than the value of the asset to our books. So it's a loss on sale. So I'm going to go back to my statement of cash flow. Loss on sale of land. Losses would have decreased net income. So in the statement of cash flow, we're going to add back for that loss because it's not cash coming in. So in the inner column, 3,800 is a positive number that you're going to include. For the next item that we need to add back for depreciation expense. So we're going to use the accumulated depreciation information here. Accumulated depreciation is a contra equity account, or sorry, contra asset accounts. The beginning balance and the ending balance are on the credit side. Beginning balance was 11,000. Ending balance is 16,000. It said that the equipment, they had new equipment purchases, but there were no disposals of equipment during the year. So we don't care about this side. So we know the only change to accumulated depreciation is for depreciation expense that's recorded during the period. So it went from 11,000 to 16,000, an increase of 5,000. So depreciation expense for the year is $5,000. Depreciation's an expense. It would have reduced net income. So on a cash basis, we need to add back for that amount. And there's the 5. The remaining items is going to be the changes to those current asset and current liability accounts. So we're going to start with the calculations over here. Accounts receivable went from 85,000 in the prior year to 80,000 in the current year. It decreased by 5,000. Inventory went from 20,000 in the prior year to 61,000 in the current year. It increased by 41,000. Prepaid insurance decreased from 16,000 to 8,000, so a decrease of 8,000. Current liabilities, we have accounts payable that went from 36,000 to 30,000, a decrease of 6. Wages payable went from 27,000 to 35,000, an increase of 8. And then interest payable went from 15,000 to 16,000, an increase of 1,000. The last one, income tax payable, went from 8,000 to 11,000, an increase of 3,000. For current assets, it has an inverse relationship. If it increased, you're going to subtract for that increase. If it decreased, then you're going to add for that decrease. So we're going to start with accounts receivable, and we're going to say decrease in accounts receivable. And we're going to add back for the 5,000 decrease in accounts receivable. We collected more cash than we reported as revenue in the income statement. For inventory, we have an increase in inventory. $41,000, and we're going to subtract for that 41,000. We expensed less than we actually spent on a cash basis, so we need to subtract for that increase. Prepaid insurance decreased by 8, so we're going to say decrease in prepaid. Meaning we spent less cash than we actually recorded as an expense, so we get to add back for that 8,000. Liabilities have the same relationship. So if a liability decreases, then we're going to subtract for the decrease. If a liability increases, we're going to add for the increase. So decrease in accounts payable. We paid more in cash than we expensed, so we're going to decrease for that 6,000. Subtract. Increase in wages payable. We incurred a higher expense on an accrual basis than we actually paid out in cash, so we get to add back for the 8,000. Interest payable also increased. Increase in interest payable. We recorded a higher expense than we actually incurred on a cash basis, so we get to add back the 1,000. Last one, increase in income taxes payable. And 3,000 is going to be added back. The total reconciling adjustments is going to be the sum of the inner column, and we're going to record it right below. one line down and the one row over. So sum of A. How much are our reconciling items? The sum of these adjustments.
Is it I had like a negative value of
It is.
13,200.
Yep. So negative 13,200 are adjustments that we had. We're going to subtract that 13,200 because it's negative from the 32,000 to calculate net cash provided by, because it's positive, operating activities. So 32,000 minus 13,200 gives us $18,800 in net cash provided by operating activities. And that's the problem. So notice we didn't use the equipment purchased for cash. We don't care because that's investing. We didn't use the no disposals of equipment, investing. We didn't care about the common stock that was issued for cash. That's financing. And we didn't care about cash dividends because that's also financing. We only used A and E from that information given. Questions on any of the problems we just went through? Okay, let's take a quick break. So the last problem from chapter 13 is just classifying the activities that affect cash flows and determining whether it's an outflow of cash or an inflow of cash. So we're going to go through each of these transactions and identify if it's an operating activity, investing activity, or financing activity, and then if it's an inflow of cash or an outflow. So new production equipment that is 60% more energy efficient than the old equipment was purchased for cash. So equipment is the key word here. Equipment is a long-term asset. So automatically this is going to be classified as what activity? It's impacting a long-term asset.
Investing?
Correct.
No.
Correct. It's an investing activity.
Oh, okay.
And is it cash coming in or cash going out? Is it an inflow or an outflow?
An outflow because we're purchasing it?
Outflow. So I'm going to show it as a negative because that's a decrease in cash. Number 2, when the plastic wood is cut into lengths needed to build park benches, the end pieces cut off are scrap. PLC sold this cutting scrap to another recycler.
Operating activities?
Operating activity is correct. Because obviously the wood is part of it in inventory. It's an operating activity where they sold it. It impacts the net income. And is it an inflow or outflow?
Inflow?
Yep, cash is coming in. Number 3, engineers at PLC performed research into a new process that injects tiny air bubbles into the plastic to reduce the usage of raw materials and to reduce the weight of the finished products. So research is considered an operating activity. Research and development is expensed as incurred under GAAP.
So operating.
Yep. So I'm just gonna put R&D operating because it flows through the income statement. And it's an outflow, right? We're spending cash. Throughout the year, PLC participated in several trade shows that featured green products for use by parks and recreation facilities. For each trade show, PLC incurred cash expenses for transportation, registration, meals and lodging, and booth setup.
Operating activity.
Absolutely. Right? Because it's travel expenses. And it's an outflow of cash, their expenses. Number 5, a Toyota Prius hybrid automobile was purchased for use by the CEO of PLC. PLC paid cash.
It's an operating one? No.
Vehicle purchase.
Oh, vehicle.
Vehicles purchased, so it's a long-term asset. Therefore, it's investing. And you paid cash, so it's an outflow. PLC issues long-term bonds during the year to help finance growth.
Investing.
So it's not investing because that has to do with long-term assets. This has to do with a long-term liability because this is bonds payable. So it's a long-term liability. So it's a financing activity. And when we go out and we issue bonds, is it a cash inflow or an outflow?
An outflow.
So you're taking out debt.
Wait. Okay, taking out debt. So we're having stuff.
So when we pay off the debt, it's an outflow. When we issue debt, it's an inflow of cash.
Okay.
Right? We took out a loan, essentially. For number 7, PLC became a minority partner in a solar panel electricity generation project by investing $1 million in cash in the project. So this would be an investment. Okay, so a long-term investment. Long-term investments are considered long-term assets. So it's going to be an investing activity. And it's an outflow of cash because we're investing in it. For number 8, a fleet of plug-in electric cars was purchased for sales staff. PLC paid cash. So you have 3 car ones.
So investing.
Investing. And then outflow. A wind turbine was built to power part of PLC's operations. A wind turbine would be classified also as a long-term asset. I'm just assuming that most of you are not familiar with that industry. Investing activity. And it is an outflow of cash. And for number 10, PLC installed a living roof on its manufacturing facility. This roof is made mostly from sedum runoff and doubles the expected life of the roof over that of a conventional roof. Plants also reduce heating and cooling needs by providing an extra layer of insulation. Additionally, the plants absorb carbon dioxide to help reduce greenhouse gases. The living roof was paid for with cash. So the key part here is that it doubles the expected life of the roof, meaning that it can be a capitalized cost, and it's going to be included as part of long-term assets. So it's going to be an investing activity, and it's an outflow. So that problem's worth 10 points. I know that chapter 13 is difficult, so I try not to give you too hard of problems from that chapter. Chapter 8 is the last chapter. There's 3 problems from that chapter. And I believe, yeah, each of the problems from chapter 8 are worth 15 points, so 45 points total for chapter 8. The first problem from chapter 8 is a special order decision. And there's 2 different requirements that you'll have to do. So 2 different kind of assessments of a special order. Perith Industries has an annual plant capacity of 70,000 units. Current production is 55,000 units per year. So they're operating below their max capacity. At the current production volume, the variable cost per unit is $30 and fixed cost per unit is $410. The normal selling price of Perith's product is $45 per unit. Perith has been asked by Rummel Company to fulfill a special order for 10,000 units of the product at a special sales price of $25 per unit. Rummel is located in a foreign country where Perith does not currently operate. Rummel will market the units in its country under its own brand, so the special order is not expected to have any effect on the regular sales for the company. How would accepting the special order impact Perith's operating income should Perith accept the special order? So with a special order, we know that the normal selling price is not relevant. Right? So I'm just going to cross that out. I don't care that they normally receive $45 per unit as a selling price. We're willing to accept a lower amount. What we're first going to compare is that 10,000 units, right? Which is the number of units in the special order at the $25 per unit selling price. So the revenue from the special order. 10,000 units, which if you notice, when you add 55,000 to 10,000, you're still under your max capacity, times $25 per unit special order selling price. And revenue from the special order is going to be $250,000. We're comparing that increase in revenue to our increase in cost. Which of our costs are going to increase? If we have an increase in sales, we're going to have an increase in certain types of costs. Fixed costs are not going to change unless stated otherwise. They said nothing about fixed costs changing, so we're assuming that the fixed costs of 410 are covered by their normal volume of sales. So the only costs that are relevant to this decision are the $30 per unit variable cost. So 10,000 units in the special order times $30 cost per unit we're going to incur an additional $30,000, sorry, $300,000 in cost. We're comparing that increase in cost to the increase in revenue. And notice that the revenue increase is less than the increase in cost. So what's going to happen to our operating income if we accept the special order at $25 per unit? It's going to decrease by 50,000. So what would you tell the company at this point in time? Do not accept the special order. As operating income decreases. Right? Your incremental revenue is less than your incremental costs for the special order. Does requirement 1 make sense?
Yes.
Okay, you're going to do something similar for requirement 2. How would your analysis change if the special order sales price were to be $40 per unit? So now we're still going to sell 10,000 units. But the selling price is not $25 per unit, but $40 per unit. So our incremental revenue from the special order would be 400,000. And there's more, and Perith would have to pay an attorney fee of 15,000 to make sure it's complying with export laws and regulations relating to the special order. Do we still incur variable costs?
Yes.
Yes. So that 10,000 units in the special order times $30 per unit is still relevant. So 300,000 is still relevant as a cost. Sorry, I'm just going to move the 400,000 to the outer column really fast. And then we're also going to incur an additional fixed cost, which is the attorney fee of 15,000. So when I add up these two costs, these new costs, increase in costs, it's 315,000. We're going to subtract the 315,000 and compare that to the increase in revenue of 400,000. The increase in revenue is greater than the increase in cost. So we're going to see an increase in operating income because it's going to be positive of $85,000. In this case, they should consider accepting. the special order because it increases operating income. Does that one make sense?
Yeah.
So with the special orders, you're only focusing on the stuff that changes. I'll let you finish up writing this. Exercise 823A is the dropping a product line problem we're going to look at. Top managers of Vermont Flooring are alarmed by their operating losses. They are considering dropping the laminate flooring product line. So this is the product line we're focusing on, the middle one. Company accountants have prepared the following analysis to help make the decision. So they've given us sales revenue, variable expenses, contribution margin, fixed expenses, and then the operating loss that it looks like laminate flooring has. Total fixed costs will not change if the company stops selling laminate flooring. So what does that mean about the fixed costs that are included, the $55,000 and the marketing and administrative costs? Are those considered to be avoidable costs?
No.
No. So we know right now that that 55,000 and the 19,000 are unavoidable, and it's just going to be shared by the other product lines the company offers. So it's not part of our analysis. Prepare an incremental analysis to show whether Vermont Flooring should discontinue the laminate flooring product line. Will discontinuing the laminate flooring add $28,000 to operating income? Explain. So we're going to compare the benefit that they're giving up, the decrease in revenue. If we drop the laminate flooring, so 128,000 in revenue would be gone compared to what their cost savings would be, which would be the variable expenses. So they're giving up revenue of 128,000 and they only have a cost savings of 82,000 in expenses. So it's expected to have a decrease in their operating income of how much? 128 compared to 82,000.
$46,000.
Yeah, I'm just going to do one thing right here. It doesn't show it as negative in your problem, so I don't want you to put it as negative. So it'll decrease their operating income by 46,000. And they do show this as a negative number because the benefit, you're giving up the 128,000 benefit. So essentially this should be negative, but they're not showing it as negative compared to the cost savings of 82,000. So you're giving up more revenue than you're saving in expenses. So you would see a decrease of 46,000. So they should not drop the laminate flooring line. Operating income would decrease. For requirement 2, they have a little change. Assume that the company can avoid 32,000 of the fixed expenses by discontinuing the laminate flooring product line. These costs are direct costs of the laminate flooring product line. Prepare an incremental analysis to show whether the company should stop selling laminate flooring. So now they still will have a decrease in revenue, right? 128. They still will avoid those variable expenses if they drop it of 82. I'll use the inner column. And now we're going to add an additional cost that they're going to avoid, 32,000. Fixed costs avoided. So we're going to add up these two expenses that they're going to avoid. 82 plus 32, 114,000 in costs that we're going to avoid. So we're giving up the benefit of 128, but we only have a cost savings of 114,000. So what's going to happen to our bottom line again?
We would lose out on like $14,000.
Yep, we're going to decrease by 14,000. So again, you would suggest do not drop laminate flooring. For the last part, now assume that all of the fixed costs assigned to laminate flooring are direct fixed costs. So now I can erase that because that's a direct cost and can be avoided if the company stops selling laminate flooring. However, marketing has concluded that wood flooring sales would be adversely affected by discontinuing the laminate flooring line. Retailers want to buy both from the same supplier. Wood flooring production and sales would decline 10%. What should the company do? So we have expected decrease in laminate flooring revenue. Obviously, we're giving up that benefit of 128,000. Again. And then we have some expenses that are avoided. We have variable expenses that are avoided of 82,000. And now we have all of those fixed expenses. So 55,000 plus 19,000. So $74,000 in costs that are avoided. Which is going to give us expected decrease in total expenses. So I'm just going to erase that.
$156,000.
156,000. Right? So we're going to compare that to our revenue that we're giving up, right? To get an expected increase in operating income, right? Because those expenses that we're giving up are greater than the revenue that we're losing. So 28,000 positive. But we're not done here because we have lost contribution margin on wood flooring, the other product line. So we're going to lose 10% of the contribution margin from the wood flooring line, which is 150,000. So 10% loss times 150,000 contribution margin. So that's going to be $15,000 in contribution margin that they're going to give up. Compared to that cost savings that they have, 28,000. So they're going to have a positive number here. 28 minus 15 of 13,000. So the cost savings is greater than those benefits that they're giving up. So they would actually have an increase in operating income of 13,000. And in this case, they should consider dropping laminate flooring. So that's the last part for the dropping segment. One last problem, constrained resource problem. And at least they give some hints too, how to calculate it. This problem's also 15 points. Treadfast produces two types of exercise treadmills, regular and deluxe. The exercise craze and related demand is such that Treadfast could use all of its available machine hours producing either model. So machine hours is our constrained resource. The two models are processed through the same production department. And we have an allocation based on machine hours. So overhead is allocated based on machine hours. We have our deluxe model and then our regular model. First thing we need to do, because it's not given to you, is you need to calculate contribution margin per unit. So contribution margin is sales, the selling price per unit, minus all variable expenses. So the deluxe model has a selling price per unit of 1,000. The regular model has a selling price per unit of 540. And then we have four variable expenses. Direct materials of 340 for the first model, and then 80 for the regular model. Direct labor is 82 versus 194. Variable manufacturing overhead of 152 versus 76. And then variable operating expenses of 125 and 59. So you're going to add up these costs. And you know what? I should have written them inside here, but I didn't. So for deluxe, we have how much in variable expenses?
Is it 699?
Yeah, $6.99 per unit. And then for regular, you have variable expenses per unit of $409. So we're going to take $1,000 per unit minus $6.99 per unit to get the contribution margin per unit of 301. And then we're going to take $540 per unit for the regular minus 409 to get 131 per unit in contribution margin per unit. What product mix will maximize operating income? Hint, use the allocation of fixed manufacturing overhead to determine the proportion of machine hours used by each product. So notice that fixed manufacturing overhead is allocated on the basis of machine hours. And total fixed manufacturing overhead divided by total machine hours is how we're calculating the fixed manufacturing overhead per unit. So if we have fixed manufacturing overhead of $80 per unit for deluxe versus regular, that means that the deluxe model is using 2 times the amount, correct?
Yes, yes.
Yeah. So it takes twice the amount of time to produce the deluxe that it does for the regular. So in 1 hour, you can produce how many units of the regular?
2.
2. So 2 units per hour. And in 1 hour, you can only produce 1 unit of the deluxe. So our contribution margin for the equivalent number of machine hours, which is our constraint, 301 per unit times 1 unit per machine hour. We're going to eliminate the units and left with 301 per machine hour is what we're earning. And for regular, it's 2 units per machine hour. So 2 units times 131 is 262 per machine hour. So which of these would you maximize and meet demand for? Even though it takes twice as long to make 1 unit of the deluxe is the one that is the most profitable in relation to the constraint. So you're going to maximize and meet demand for deluxe first. And whatever you have time for later will go towards the regular. That's it for the test.
Hey, all right.
Good.
What was the formulas at the bottom for?
I didn't use them this time. I didn't need it.
Oh, okay, cool.
Yeah, so I'll just erase it.
Those ones are easy.
Yeah, it's not too bad, right?
No, not at all.
Practice, you'll be fine. I know you will be. It's been a pleasure, you guys. I figured not very many people would be here because this is what happens in managerial accounting. Nobody takes my final.
Aw, man.
It's not like financial. I think financial, you guys are scared, so you all want to take it. But I'll miss you. Keep in contact. I know a lot of you are transferring, but
We're gonna miss you.
Missed you too.
you know how to find me.
Okay.
Thank you,
Still
Professor.
follow the accounting professor Instagram.
Yes, you can still do it
Okay, cool.
and catch up. You have until Monday.
Okay. I'm
Okay.
gonna email you right now about the Excel project, and
Perfect.
then
So,
everything.
so just to confirm, we don't have class
Okay.
on Monday, right?
No class on Monday. This is your last class.
Okay.
So
Oh.
I'll be available on Monday if you guys have any questions, though.
Thank you.
Okay,
You're
thank you,
welcome.
professor.
Have a good weekend. See you guys later. Catch up.
Okay, later. Okay, I will. Don't worry. All right. See you
Thank you,
later.
Professor.
Bye, professor.